To the casual observer, it's business as usual. To those paying attention, there's much more going on. I want to talk about a few issues related to the markets and, of course, connect that in with the economy. The first thing I want to talk about is the inflation sensation. I'm going to quickly note a few points. I know you've heard many of them before, so I just want to highlight those at the beginning, and then we are going to talk about the second thing. Who's winning? What's going on here? Who benefits under a higher inflation? What's going to happen? All of that. And then the third is the party over. Many are starting to ask that question. Some are running for the exits already. There's much to discuss. Let's begin. Let's start here. Little Caesars raises prices of the famous $5 pizza for the first time. This has been for decades, and now suddenly they have to raise their prices. Imagine how many different events have happened over these prior years. Nothing has changed the price. And now suddenly, just like many other brands, they've had to do the same. The average monthly rent in Austin is now $1,500. Prices are rising at the fastest pace ever. It's not just Austin, it's all over the place. This article here is talking about the iBuyers, which is like Zillow and other companies that are basically using huge swaths of cash that are so cheap to come by these days, buying up the houses of single family homes. They own tens of thousands of homes over here and over there. A lot of this is coming in the south of the United States. But of course, I think this is going to be a bigger trend going all over the place. What does that mean? Well, of course, when you have these huge buyers, these type of landlords are not the mom and pop type landlords. They really don't care what happens to you. And I think this is a big concern. What do you think? Let me know down below. Is the inflation and of course what's happening with the iBuyers and with all of these different companies coming in and buying up your neighborhood a problem? Let me know. Looking at the next topic here, what we are seeing first is coming from Ray Dalio. So I'll show you the charts here, and you could see that he's just highlighting a bunch of things within this article, but real bond yields, nominal bond yields, real bond yields right here, just breaking it down. And you could see, if I show you, looking at this, it was bad back in the late 1940s. But let me tell you right now, it's the worst ever for real bond yields. Nominals, okay, same situation. Look at that, right? And then we see this, nominal cash rate. Again, worst ever. So what's happening today should be, in my opinion, a concern to many. And what has been the case here? What have people done? What have investors been doing? I think it's pretty clear. They've been putting their money into the stock market. But as time goes on, and this fluctuates, of course, we have noticed that there have only been a small group of stocks that have been carrying the market higher. What has been the most recent example? I mean, come on, Apple, $3 trillion market cap, 52-week market breadth has fallen sharply over the last 6 months. And this always happens when you have this weakening that occurs where the breadth goes down, and yet the stock market can carry higher. It's not so one-sided, but that's the way it's been working. This is the S&P 500, and you could look at this over the last little while. We're just looking at this middle portion of the chart, and it has gone higher for the most part. I mean, it's been a little iffy over the last while. I mean, basically since beginning of November, it is up since then, but it's been struggling. It's been struggling to get along. And what's been going on here? Well, like I said, there has been a few stocks carrying it up. 35% of the S&P 500's year-to-date return has come from 5 stocks. And you could see Apple right here, but you got to look at this. Microsoft and Google as well. Share of the SPX year-to-date return as of December 9th. I mean, just look at where Apple is today. But you look at others that are underperforming, like Amazon and Facebook or Meta. You see this coming at a time in which interest rates are at rock bottom. Now, what is going on here? Well, the threat here is that interest rates will rise. But what does that mean? What would that do to the markets? Well, of course, there is a relationship that I talked about in my first book where we have interest rates low, stock market high. And that's it. That's the way this has been working over the last few decades. When interest rates are low or declining, stock markets can go up, and then the inverse relationship as well. But they won't do it. GPS, they won't do it. Well, we'll see. The tightening has already begun. Weight of the top 10 stocks in the S&P 500. Just look at that. As time goes on, these stocks become more and more and more important. And when everything is working well, there's no issue. There's no issue at all, because all you got to do, I love this, dollar cost average, right? Here's another one for you, into your ETFs. And why do you need to worry, right? Dollar cost average into your ETFs. I actually saw a very popular YouTuber, and I was skimming through the video just because I wanted to note what he said, because I knew that the title of the video was not going to be what it was all about. And in fact, he would say the opposite, and it was correct. He said, I am going to resolve any issue. I'm not going to deal with any problem in this coming year, because I'm going to dollar cost average into the ETFs. He made it seem as if this was a secret. Now, of course, that works on the way up, but it is very painful on the way down. That needs to be understood. What has happened here? Investors, retail investors that is, have learned that any correction is met with more stimulus, more pumping. Since the financial crisis, and let's focus just on 2021, there have not been any dips. Okay, let's be honest. There have been no dips. But during this period of the buy the dip, I have trouble even saying that. But anyway, there haven't been any real dips. But during that period, anytime the market has just gone higher. Okay, let's be honest. That's what's happening. So that's the programming that these retail investors have seen. Just keep pumping the money in, dollar cost average, dollar cost average. But you see, it gets to a point in which it can break. This is just showing you who stands to gain. I told you I'd give you that information, and I've done videos about this before. But banks. The banks do very well when inflation, or I should say interest rates, go higher. This happens to be in this particular trading day, and you could see what happened, accelerating. At the same time, NASDAQ not performing very well. In fact, if I look at that, it was down 1.33%, the NASDAQ. At the same time, by the way, Apple declining throughout this period, okay? So I could show you right now really quick. Apple had done very well, and then it turned around the next trading day, taking a hit. If we look at, for example, the QQQ, which is essentially the NASDAQ, look, going back to levels we have not seen since November 4th. November 4th. I mean, it did perform well prior to that. I'm not suggesting it. I'm saying it's been chopping around throughout this period. And you know who benefits throughout this? It's people who are able to realize this and see for themselves, what can I do? Well, they can be on the right side of the trade, but they can also be on the right side of a swing trade. It is investors that are looking at the choppiness, the volatility, as a way to play both sides. You don't have to get scared when the markets come down, and you don't need to put hateful comments when the market is going down. You can buy puts. You can buy inverse ETFs. You can do this on the short term, thinking that, you know what, it's looking pretty weak right now. I can get in on this and learn the skills and so on. But that's a whole different topic, isn't it? Now, is the party over? That's what many have started to suggest, and that's what we'll talk about right here. Looking at this, it's from JP Morgan, our favorite JP Morgan. JP, they are always bullish. You never see them being bearish, but JP Morgan strategists say that the global stock market party is far from over. Strategists say that positive catalysts not exhausted for equities. Societe Generale also says that the bull market will continue in Europe. Stay bullish. Positive catalysts are not exhausted. That was the quote from them. Here you can see, number one, I wanted to note the outlier, and that is emerging markets. Comparing emerging markets to the US, it is very clear. So if you do believe that there is a lot left in equities, well, then emerging markets look very attractive, don't they? But I think if we break it down to the sector, if we believe that inflation is going to go higher and that interest rates will go higher as a result, you can look at the banking sector being one of those that will benefit. Right now, commodities. Some people out there were saying there's a deflation. Look at what's happening with lumber. It was only temporary. But no, lumber is again on its way to approaching its record high. Even though it's insane, even though it's crazy, right? Look at what's going on. There are ways to profit from it, if you so choose, or you could simply back off and say, I don't want any part of this casino. That's up to you. I simply provide the data. US equity giants valuation echoes .com exuberance. And that's what we get, you see? Valuation question, largest US stocks almost expensive as during the .com bubble. And that is part of the reason why we have seen the NASDAQ doing what it is doing. It's getting a little bit exhausted, isn't it? During this period of time, could it be? Well, only a few names carrying the market. That's not good. Now look at this. What's happening in real estate, a lot of consolidation. And I believe that this is a huge, huge business opportunity. CBRE investment to buy $4.9 billion in warehouses in US and Europe. Well, this right now is the number one play. All of the warehousing was performing extremely well for obvious reasons, Amazon and so on. Now, robots, automation, still taking over. Wanted to bring you an update. Deere to bring fully autonomous tractor to the market this year. Does it work as well? Well, I know that it doesn't take days off. I know that it doesn't have a problem showing up. And I know that businesses, agribusinesses, are going to be looking to increase their profit and increase their, the name escapes me. I'm going to get it in a second here as soon as I hit pause. Productivity, that's the word. They're going to increase their productivity because that's what businesses do. It's not family farms. It's not small farms. It's the agribusinesses. They're taking over. And then you stayed into the end so you get some humor. The goldfish were pretty good at piloting a fish-operated vehicle. I'm serious. Okay. Fish-operated vehicle. Basically, this is out of Vice, but anyway, they kind of made them look ahead, and their vision ahead essentially propelled this device forward. Maybe this could be the next Uber driver. I don't know. I just thought it was funny, I wanted to bring that to you. All right. If you found the video informative, hit that thumbs up button. If you found it wild and wacky, let me know what you want. Let me know what you think. Put it in the comments below, okay? All of these comments help to support the channel, so I do appreciate that as well. Don't forget to subscribe and hit that thumbs up button. All of these things are so important, okay? And a lot of you think you're subscribed, but are actually unsubscribed by the algorithm. So check that out and make sure you hit that little bell icon as well. If you haven't seen this video yet, click it, and I'm going to see you over there.